Hi everyone, welcome to this week's edition of Midweek Market Update. I'm Ashley Roster with Victory Fiduciary, and today we are coming to you from our brand new studio. And so you know that over the past months, this has kind of evolved into a weekly video series that we decided to keep permanent. And so one of the things that we decided was that we wanted to actually dedicate an entire room just to being able to produce this weekly video as well as other videos that are going to be coming. And so very excited to be here today in this new space. We have a brand new interactive screen that we're going to be taking a look at today, still learning kind of all the ins and outs of it, but super excited just to be able to share this with you, and we'll be learning kind of as we go through these next few weeks. So today what we're going to talk about is Santa Claus coming to town when it comes to the stock market? And can we expect that typical end of the year Santa Claus rally? And so you know that in September and October, we saw a pretty significant correction. So we saw the highs at September 1, and then I'm going to go ahead and show you here where we have a nice visual here of kind of just what we saw. And so here we were at the highs of September 1. We saw that correction. These are all three of the major indexes. Then coming up into October, again, significant corrections. And then as we came into November, so remember we talked about the fact that there was some risk in the market at the beginning coming into the election, and then we came up and had a very sharp rally after the election, after a lot of the uncertainty kind of went away, especially as we found out that it's likely that Congress is going to be gridlocked, which while that kind of sounds like a bad thing, the market really likes it because it means that it's likely that neither policy or neither party is going to be able to have kind of radical policy on either side. So that winds up actually being very bullish for the market. And so even though in these 2 months here, we saw declines of about a negative 7.2%, as you can see, we had pretty sharp rallies then. And so we were able to finish up positive. Actually, for the month, we were up about 10%. And then over that 3-month time period, this is where those indexes kind of fell. So as you can see, coming in the beginning of December, markets have kind of have set themselves up to potentially carry into the end of the year with a strong finish. One of the things that we talked about last week, and just as a reminder, these next 2 weeks still absolutely have the ability to be a little sloppy within the market. Number one, mutual funds are going to have to make their mandatory distributions. And right now, mutual funds have the lowest amount of cash on record when we look back at history. So that means they're going to have to make some sales to be able to raise the cash that they're going to need for that. That could potentially put some downward selling pressure on the markets, at least in the short term. Pension funds are also going to be going through their annual redistribution, and so taking from areas that have maybe become super overbought, those areas maybe trim back. And again, so don't be surprised in the next few weeks if we see just some downward price pressure on the market, at least temporarily. I think, though, that it's likely that once we kind of get through those next 2 weeks, that we will probably see a pretty strong finish to the year, as typically that bullish trend kind of can get drugged through the end of the month coming into the year, and especially as portfolio managers are kind of positioning their portfolios for the coming year. So typically, I use the word typically with quotes because 2020 has certainly been anything but typical. We typically will see a strong finish to the year. So we'll have to see if that plays out for us for the end of this year. But I do want to remind us that there is still long-term risk in the market. And so when we look at these funds here, you know that we have mentioned over and over again the fact that we are extremely deviated from our long-term moving averages. We're extremely deviated from the corporate earnings when we look at S&P 500 pricing versus what actual earnings are coming from the companies affiliated with the index, completely detached. And so we're deviated from our long-term moving averages. We're detached from corporate earnings. Fundamentals are really still not that great. I mean, we saw the ADP jobs numbers came in today. It was softer than what we expected. We added less jobs on payroll than what was expected. We continue to see, we've kind of stagnated at over 700,000 new jobless claims a week. We've kind of grown used to that. So, these are things that eventually are likely going to weigh on markets, and things that we need to be kind of keeping into the back of our mind, because many areas we're paying a premium to be invested in the market. So we're paying more expensive prices in areas of the market that have the potential to have elevated risk. And so, as investors, we've kind of been stuck between, so what do we do? Because we're hired to find performance for our clients. And so I say all the time that we have three main roles as investment managers. So we want to find ways to reduce risk, reduce volatility when possible, and then we want to take what the markets will give us. And so, that means that we have to weigh all three of those sometimes. It's kind of like a balancing act. And so as we have made portfolio allocation changes based upon the program and strategy that we use, we've really, we've had to stick to our process. And so for now, as our technical indicators have told us that it's a go and that we should be participating in the market, the good news is that while there is widespread risk and there are absolutely things that are concerning us within the market, we have a program that allows us to kind of find the areas, those sweet spots of the market that could give us the best opportunity for performance. And at the same time, it's steering us away from the areas that would likely have negative consequences in terms of being drags on performance and potentially having lower possible returns. And so we use something called relative strength. We look at things like momentum. And so what I'd like to do is just kind of show you how this works. And we're thinking here. Okay, and so I'm just going to make this a little bigger for us here. Now, what I want to show you, and hopefully you can kind of see these numbers. So one of the things that I'm looking at as we're taking positions within our portfolios is that we want to know how are we performing relative to the rest of the markets. And so we have taken a very tactical, very strategic approach in how we choose the investments in our lineup and how much we have allocated to those areas. So I just kind of want to show you. So when we look back, so these are 3-month numbers. So this was as of November 30th. So we are looking from September through November. What have our individual holdings done? And so the S&P 500 total return over this time period was 3.89%. So now we look back, and I wanted to see, so then how did our holdings in our portfolios hold up? And so when we look at our mid-cap fund in that same time period was up 9.2%. Our consumer discretionary fund was up 10.9%. Our innovative tech fund was up 15.2%. Our industrial building construction fund was up 14.2%. Our large cap growth was up 8.2%. Small cap was up 8.6%. Our online retail fund was up 16.1%. And then we had a high yield bond fund which yielded 2.34%. So obviously that was the fund that lagged the market. You would expect that fixed income would be lagging the market over the long run. That was kind of used as our stabilizer, which served us very well, especially during those periods of significant corrections in September and October. And so here's the idea, though. This is the point that I want to get across. When you use a program that uses things like relative strength, positive momentum, steering us away from the negative areas, that's how we're able to get these performance numbers, those funds that are doing so much better than the market. Because if you want to be able to beat the market over the long run, you have to find individual holdings that are going to do better than that 3.89%, which is what the market did. And so that's kind of how it works. So what I'm excited about here and with some of the things that we're going to have is that I'm going to be able to actually show you parts of our process, how it works, how we actually go in and look at areas. These are things that I'm going to be able to show you in real time. So I'm excited to be able to do that certainly with you. So in terms of what we're doing as advisors right now, we have increased equity exposure. You know, we've been doing that over the past few months. We've used these past corrections that we've had to kind of add to some equity allocations. And so, you know, for now, we are holding, we are watching the technicals very carefully. We are watching areas of relative strength and momentum to make sure, because again, Eventually those cycles will complete and we'll have to reallocate to new areas, but for now they are serving their purpose very well. And so that's really what I wanted to get into. So yes, there continues to be elevated risks within the market. Short term, I think that, like I said, negative or downward price pressure will be expected. And then, for 2021, we're just going to kind of have to just pay real close attention, because the one thing that we want to make sure is that, we don't take more risk than we need to be taking. And so as investors, if, as you're looking at your portfolio, you want to make sure that you kind of have a purpose, that you know why you hold the areas that you're holding. So they should all kind of be serving a purpose within your portfolio. You want to make sure that you let your runners run and you cut your losers quick. So those are things that, that we are constantly looking at. I'm always happy. If you have questions, you can always give me a call. If you want to know a little more about what we do, or you have questions about your investments, we'd love to be able to have conversation with you. And so that's it for today. I hope you had a wonderful Thanksgiving. I hope you're staying safe, and we'll look forward to seeing you next week. Have a great day.